Hello and welcome to another video on my YouTube channel. My name is Joris and today I am here with a video about the IncomeShare ETPs. While about 3 weeks ago I received a message from one of my viewers and it's Lenat681 and they said, "A great update, Joris. Always nice to hear a European perspective." Nice to hear that, of course. "I'd love to know your thoughts on the recently released European ETPs, IncomeShares. Some of the monthly payouts are utterly obscene." So I replied that I didn't know much about them because I hadn't looked into them, but I would read up on them, and that's what I did. So here is my video about them. So what are ETPs? Well, ETP stands for Exchange Traded Products, and ETFs are in fact also exchange traded products, but they are regulated by the UCITS, so the Undertakings for Collective Investment in Transferable Securities in Europe. And this regulation, which in fact gives protections for investors, is the major risk difference between the ETPs and the ETFs that you can buy on the European markets. But it isn't the only risk ETPs carry, so it has additional risk on depending on their structure and on their underlying assets. But in all honesty, that's in fact also the same for ETFs. On the 6th, you also have ETPs. You have 213 to be exact. And most of them, around 70% I estimate, are oriented towards cryptocurrency, so Ethereum and Bitcoin. If you're into that kind of stuff, you can actually find more interesting ETPs than you can find interesting ETFs on the SIX stock exchange. And I did not look into the IncomeShare ETPs. While they are not available on the SIX yet, they are available on the Xetra and they are available on the London Stock Exchange, but not yet on the SIX stock exchange. The ETPs of IncomeShare started around July or August of last year, so they are still young, around half a year old, and they are oriented towards generating a high income stream. And they really do. If you look at this table here that you can find on their website, you can see distribution yield for the TESLA IncomeShares TESLA option ETP, 88.21% as distribution yield for now. And it uses a covered call strategy. For NVIDIA, you have 33.07 distribution yield. And then, okay, you have here normal distribution yields for Amazon, for Apple and Google. So those are actually quite okay. And then you have one for Coinbase with 94.64% distribution yield, which is quite insane. Then the Meta Options ETP is 26.44% distribution yield. Then you have the Microsoft one, which is again a normal one with 5.77%. Then you have the Nasdaq 100 ETP with 87.92%, which is also insane. And then 60.01% for the S&P 500 option ETP. And yeah, then you have one on gold, and gold doesn't move that much. Okay, it went up the past few months, but there the distribution yield is only 3.56%. So nothing abnormal there. But you have a few that are really insane. So let's go into those a bit. But first off, you have the ETPs, so they can provide you with an alternative income stream. The ones from IncomeShares are oriented towards covered calls on specific assets. So you have the stocks that I all mentioned on the previous slide, or you have crypto, Coinbase, or gold, or they are oriented on cash covered put options on indexes, and that's then the S&P 500 or the Nasdaq 100. So the IncomeShares offers 7 ETPs on individual shares, one on Coinbase and one on gold. and 2 ETPs on indexes, so the S&P 500 and the Nasdaq 100. They entail a higher risk than the covered call ETFs, not only because they don't have the UCITS protection here in Europe, but also because, yeah, you have the NAV that is eroding, and I will explain that in the next few slides. And the NAV is actually the net asset value of the ETP that is eroding, and that's something that you don't want to see because that is actually a sign for a dividend trap. And as a dividend investor, you always want to avoid running into a dividend trap. They are, in fact, more similar to YieldMax ETFs from the USA. So if you are looking at videos on YouTube around ETFs from YieldMax and you like that kind of stuff, then these ETPs are an alternative for you. But if you are living in Switzerland, you will have to go outside the SIX because on the SIX they are still not available. And TSLI resembles TSLY from YieldMax, and some of them also have the Y at the end from IncomeShares. So I think they really want to have the resemblance with the YieldMax ETFs. But TSLY I started at $9 and is now trading at 7.51 US dollar. So the net asset value is eroding of this ETF, but they paid out 3.4635 US dollar already. So this represents a distribution yield of 88.21% as is visualized on their website. And that's true because when you recalculate it for a whole year, this return, then it's 88.21%. So they exist more or less a half year, and 3.46 is more or less 40% return on $9 US. So if you extrapolate that for a whole year, it's 88.21%. So that's totally correct. But in fact, the total return for now is only 21.9%, and only is to take with a bit of salt because yeah, it's still enormously. It's up 21.9%, which is it's quite nice. But Tesla is up 34.3% since the 22nd of July, the day that TSLI started trading on the stock exchange. So actually it was better to just buy Tesla on the 22nd of July instead of buying TSLI. But if you want the income, of course, then TSLI is the better option, because otherwise when you want the income, you have to sell your Tesla shares. The covered call here is also not quite the same as covered call for JEPI or XYLF. So yeah, it's the same strategy, that's for sure. But for JEPI and XYLF, you have 500 underlying stocks in the index. Here, in this ETP, you only have one underlying asset, and that is Tesla. So when Tesla performs bad, the ETP will perform bad as well. And JEPI and XYLF, they have way more buffer. So when Tesla performs badly in the S&P 500, you have 499 other stocks where the fund manager can try to make up for the losses of the Tesla losses that they incur. So in that regard, I think it's better to go for covered calls on indexes instead of on individual shares, like also the YieldMax ETFs are doing. So I don't like those kind of ETFs or ETPs at all. And if you look at XYLF's total return, it was 19.3% in 2024. And for the S&P 500, it was 24.7%. So XYLF underperformed the S&P 500 in 2024. But XYLF provided 9% of an income stream, so it didn't erode the net asset value of XYLF at all. In fact, the net asset value of XYLF went up with 10%. But here you see that even though the total return is 21.9%, the net asset value of TSLI is actually reducing by quite a lot. So time will tell because these ETPs are still young, but looking at the history of the YieldMax ETFs, I don't think the future of these ETPs are looking too bright. But that's just my opinion, it's not financial advice, and you should always do your own due diligence. And then you have SPYY and QQQY. So here you see that they also use the Y, like YieldMax. Although they are IncomeShares with a I, they use here the Y as a symbol for those index ETPs. And these use 0 DTE cash covered put options. And that are 0 days till expiration options. So it's also not the same as XYLF or JEPI because those use covered call ETFs on S&P 500 companies or on the index. But here it is cash covered put options. And moreover, it's the 0 DTE type, and they are very tricky. So they have a high time decay, they are very volatile, and they require a lot of knowledge about option strategies. I don't have the knowledge about option strategies like hopefully IncomeShares does have, but because I don't have that much knowledge about option strategies, I rather stick to covered call ETFs on indexes than I go for 0 DTE cash covered put options ETPs. So, and I took SPYY as an example. So they started at $9 and now they are trading at 8.419 US dollar, and they distributed 1.8495 US dollar as income so far. So this represents a distribution yield of 60.01%. And that's once again like for the TSLI ETP recalculated for the whole year. And it's totally correct what they say, it's 60.01%. But the total return, if you add 1.8495 to 8.419 US dollar, you get a total return compared to the 9 US dollar of 14.09%. The S&P returned 13.96% since the 27th of August, so the day that SPYY started trading on the stock market. And that means that SPYY actually outperformed the S&P 500 in that time period. XYLF returned 16.11%, so XYLF is actually performing the best of SPYY and the S&P 500. So far SPYY is certainly not performing badly, but still it is the riskier investment product of the bunch, as you see that the net asset value of this ETP actually eroded during this time frame. And this didn't happen for the S&P 500, and it also didn't happen for XYLF. So for me, I like the covered call ETFs more, and I'm going to stick to XYLF. If I add another income-oriented product, it would be the JEPG. But yeah, my wife and I, we have our core satellite strategy lined out, and it's going to be fixed for 2025 for sure. So I'm going to stick to our strategy that we have laid out. And ETPs, for me, no thank you. I like the insurance that the UCITS ETFs provide. And as I said in a previous video, nobody ever talks about risks. And these ETPs have way higher risk profiles. So if they don't have such high returns, nobody would invest in them. Because, yeah, higher risks need to come with higher returns. But for me, I like, or I just need 8 to 10% on average. And that is what I get with my portfolio for sure on the long run. So I'm not going to seek extra income by going into something with a high risk profile that I'm already having in my portfolio. So why should I go for an ETP with a way higher risk profile to get a return that I actually am not aiming for? So I'm happy with a lower return because I want to be able to sleep at night. And the one thing that I certainly don't like is the fact that they say steady cash flow on one of their pages on their website as their key takeaways. So on their website, you can read on one certain page the key takeaways, and a lot of them are true. So ETPs are exchange traded products that let investors access certain markets or strategies through a single product. Totally correct. Options ETPs use strategies like selling puts or calls to potentially generate income or manage risk. Totally correct. These products can simplify option trading while offering potential benefits like steady cash flow. They can simplify option trading because you don't have to do it yourself, but it's not true that they offer steady cash flow. They offer cash flow, that's for sure, but not a steady cash flow. And investors should always consider the risk, including limited upside and market volatility, which is absolutely correct. That's also the fact with covered call ETFs. So this last sentence is totally correct. But overall, with option strategies, the income is actually much more variable. So they should change the steady with a higher cash flow than normal dividend investments. So I hope that they change this on their website. And ETPs are not for me, but maybe after viewing this video, it is something for you. But as I always say, and it's on every slide that I present in my videos, it is not financial advice. So do your own due diligence, as this is certainly not investment advice. And with that being said, I thank you for watching to this video. If you like this kind of content, please consider subscribing to my YouTube channel. Hitting that like button helps out the channel also enormously and helps out with the YouTube algorithm. And with that being said, thank you for watching to this one and see you in the next one on my YouTube channel. Bye!